Just enjoy and listen to, and have a fun of it.
Welcome to Story Radio Station, your guide to rapid knowledge acquisition. I'm your enthusiastic lead for these deep dives.
And I'm here again, ready to unpack things.
It's great to have you. We are tackling, well, a huge topic today, really crucial for almost everyone listening: how a nation handles retirement saving.
Absolutely. It touches on personal finance, market stability, government policy. The works.
That's right. And before we jump into what's really a $24 trillion question, please take just a second, hit that like button, subscribe, set notifications. It helps us keep these dives coming.
Yeah, we really appreciate the support.
Okay, so today, the American 401k retirement system. This thing is a financial powerhouse. It completely reshaped finance, not just in the U.S., but globally. Our mission here is sort of twofold. First, understand how this, frankly, accidental system got so big, so dominant. And second, pull out the key policy lessons, especially for the Korean market right now.
And the timing on this couldn't be more critical. You know, pension reform in Korea, it's a really hot topic, very urgent, especially with the demographic shifts happening so fast.
Right, the aging population issue.
Exactly. And how well any country handles this kind of financial overhaul, well, it often dictates the long-term health, the prosperity of its own stock market.
So we're going to dissect this system that manages this just staggering amount of money. And the funny thing, as we hinted, is that it wasn't born from some grand, carefully thought-out plan. Nope. It came from a legal loophole.
A classic case of unintended consequences, really.
Okay, let's dig into that history.
Well,
So to really get the 401k's impact, we need a little context. Before the late 70s in the U.S., retirement was often talked about as this three-legged stool. What exactly were those legs?
right. The stool analogy,
Yeah.
the legs were Social Security, so government support, then personal savings, whatever people could put away themselves. And a third leg, which was really critical back then, was the defined benefit plan, or DB plan.
DB defined benefit. That was a traditional company pension, right?
That's it, often seen as the gold standard. The company basically guaranteed the worker a fixed, predictable income for life in retirement.
So the company took on all the investment risk.
Precisely. The promise was certainty for the employee. That meant the company had to manage the investments, cover any shortfalls. They bore all the risk and the long-term liability. But starting in the late 70s, things changed dramatically. Access to those DB plans just collapsed.
Why? What happened?
A mix of things. Companies wanted to reduce those long-term financial obligations. Regulations changed. And it led to this massive structural shift towards defined contribution plans, DC plans like the 401k.
Okay, DB versus DC. This sounds like more than just alphabet soup. It's often called the Great Risk Transfer, isn't it?
That is exactly what it was, a fundamental shift. Think of the old DB system like buying a car where the dealer promises free maintenance for life. The new DC system, it's like they hand you the keys, maybe an owner's manual with some investment tips, and say good luck.
Okay, so the contribution part is defined, but the outcome isn't?
Right. With DC plans, what you or your employer puts in is fixed or defined. But the final amount you have at retirement, that depends entirely on how the investments perform over decades. The risk, the responsibility, it moves squarely onto the individual worker's shoulders.
And the main vehicle for this huge transfer, the 401k, was an accident. You mentioned loophole.
That's one of the most fascinating parts. The name itself, 401k, just comes from a technical bit in the 1978 Revenue Act. Section 401, subsection K. It wasn't designed to be a national retirement system.
So how did it become one?
Well, this benefits consultant, Ted Benna, he read the text closely. He found a way to interpret this clause to create something called a cash or deferred arrangement, or CODE, basically a mechanism allowing employees to put aside pre-tax income into a retirement account.
Clever. Not what Congress intended, maybe.
Probably not explicitly, no. But it was a smart legal interpretation. The IRS eventually gave it the green light, and that laid the foundation for this multi-trillion-dollar system we see today.
And it grew like wildfire.
Explosively, because the tax incentive was just so powerful. It went from maybe 7 million participants in the early 80s to, around 80 million just a few years ago?
Wow.
And the deep policy insight there, I think, is that this huge piece of financial infrastructure wasn't proactive planning. It was an administrative accident that just stuck.
Yeah.
It tells you a lot about how financial systems can evolve through inertia sometimes.
That massive growth, as you said, fueled by tax breaks. And there are two main flavors, right? Traditional and Roth. Can you walk us through those?
Sure. The traditional 401k gives you the tax break now. Your contributions go in before taxes are taken out, so it lowers your current taxable income.
Hmm.
That's often best for people earning a lot right now in their peak years.
But you pay taxes later.
Exactly. Withdrawals in retirement are taxed as regular income. The Roth 401k flicks it. You contribute after-tax dollars today, no upfront tax break,
Okay, so why do it?
because the payoff comes later. All your qualified withdrawals in retirement, your contributions, and all the investment growth are completely tax-free. This is usually better for younger workers or anyone who thinks they might be in a higher tax bracket when they retire.
And these systems aren't static, right? They keep getting tweaked. I heard the recent Secure Act 2.0 made a big change to the Roth.
It did, a really significant one. Starting in 2024, Roth 401ks are exempt from required minimum distributions, RMDs, during the original owner's lifetime.
RMDs, those are the forced withdrawals the government makes you take from retirement accounts after a certain age, right? To make sure they eventually get tax revenue.
That's them. Traditional 401ks still have RMDs, but Roth 401ks, like Roth IRAs before them, now let the money grow tax-free potentially for your entire life. It's a huge boost in flexibility.
Wait a minute. If the Roth is now RMD exempt, I mean, doesn't that make the traditional 401k kind of less attractive for almost anyone worried about future taxes or wanting flexibility? Leaving money to grow tax-free for potentially decades longer seems like a massive advantage.
It definitely shifts the calculation, yeah. Especially for people thinking about estate planning. The traditional really only keeps its edge if you are absolutely certain you're in your highest earning years right now and desperately need that immediate tax deduction. For many others, the Roth's long-term tax-free growth and flexibility look increasingly compelling.
Okay, beyond taxes, the other big driver is the employer match. That's basically free money, isn't it?
It's the single most powerful nudge, financially speaking. If your company matches, say, 100% of what you put in, up to 3% of your salary, well, you're getting an immediate 100% return on that part of your savings.
Hard to beat that.
Impossible. It's why participation jumps when matches are offered. It'd be crazy to leave that on the table.
And the flip side, the constraint, is that big penalty if you try to take money out too early, before age 59 and a half. Keeps the money locked in.
Right, which you need for long-term investing to actually work its magic, the compounding effect. But, if the 401k is such a great vehicle, what's the catch? What's the hidden drag? I was honestly struck by how much the data points to one thing eroding wealth over time.
Yeah.
Fees.
Ah, yes. The admin fees, management fees, operating fees, they always look so small on the statement, like fractions of a percent.
They do. They compound, just like returns do, only. Negatively. Even a seemingly small difference, say 1% in annual fees versus 0.5%, compounded over 30 or 40 years. It can wipe out a huge chunk of your final nest egg. It doesn't just cost you money, it eliminates years of potential growth.
And research actually shows high fees can put people off saving altogether.
Yeah, some studies suggest high-cost plans can actually lower participation because people look at the net returns and think, why bother?
Yeah.
So transparency and keeping costs low are absolutely critical for the system to work for savers.
Okay, so we've got the structure. Born from an accident, shifts risk to workers, powered by tax breaks and employer matches, but potentially dragged down by fees. Now, here's where it gets really fascinating. How did this collection of individual accounts become this, engine for the entire U.S. financial market?
The macro impact.
Exactly. When we come back, we'll look at that market power, the surprising ways it affects stock prices, its issues with inequality, and importantly, what lessons Korea can draw from all this right now. Stay with us. 10-second pause, marker transition.
Welcome back to our deep dive on the 401k revolution here on Story Radio Station. We just covered the nuts and bolts of the system. Now let's talk scale, power, and influence.
Right, and the scale is just colossal. By the end of 2023, these defined contribution plans, mostly 401ks, along with IRAs, individual retirement accounts, held something like $24.1 trillion in assets.
$24 trillion. How does that compare to the old system, the DB plans?
It completely dwarfs them. Those traditional defined benefit plans held less than half that, maybe around $11.8 trillion. The shift is undeniable. And this $24 trillion, it has to go somewhere. It's the lifeblood of the U.S. investment world, isn't it?
Absolutely. Think about mutual funds. As of a couple of years ago, these retirement accounts, 401ks and IRAs, together held almost half, like 47%, of all U.S. mutual fund assets.
Wow. That means there's this constant, almost automatic flow of cash into the markets month after month, regardless of whether the market's up or down or what the headlines say.
Precisely.
Yeah.
It guarantees this steady demand for assets. And interestingly, that massive pool of capital is becoming surprisingly concentrated.
Oh, so?
The companies that actually manage the record keeping for these 401k plans, the big players. The top 10 now control about 78% of all the industry assets. That's way up from just 56% a decade ago.
So a few giant firms have enormous influence over where trillions of dollars get invested and what fund options millions of savers even get to choose from.
That's the reality. It raises questions about competition and choice.
And it's not just about the overall market. I saw some analysis suggesting these huge 401k flows can actually move the price of individual stocks.
Yes, that finding was pretty striking. It suggests that when large 401k plans take significant positions in a particular company's stock, those stocks tend to see returns about 12% higher than comparable stocks without that large inflow.
So it's not just passive saving, it's actively shaping market outcomes.
It seems so. You're creating this massive, constant, largely non-sentimental buyer in the market. That guaranteed demand likely props up prices, fuels performance, and acts as a kind of permanent stabilizing force, especially for the U.S. stock market.
Okay, but we know not everyone benefits equally. Participation isn't universal, especially among, say, lower-income workers or younger people just starting out. The U.S. tried to address this with that Secure Act 2.0, right? What was the big behavioral change they pushed?
The absolute key policy lever there was mandatory auto-enrollment. It leans heavily on behavioral economics. Basically, for new plans starting in 2025, most companies have to automatically sign up their employees.
They don't have to ask permission first.
Employees are enrolled by default, usually at a starting contribution rate like 3%, maybe escalating over time up to 10%. They can always opt out, but the default is in.
Why does just flipping the default make such a huge difference?
It's about inertia. Saving for retirement is important, but it's not urgent today. It's easy to put off signing up. Auto-enrollment overcomes that procrastination. The results are dramatic.
Like how dramatic?
Well, traditional plans where you have to actively opt in might see participation rates among new hires languishing, maybe 28%, maybe 80%. With auto-enrollment, that figure often jumps to over 90%.
Ah, that's massive.
It's a simple administrative change with profound impact, especially for getting those harder-to-reach groups saving early.
And Secure 2.0 also had that innovative idea for student loan debt, right? Helping younger workers who feel like they can't afford to save yet.
Yes, the student loan matching provision. This is really clever, and it started this year, 2024. It allows employers, if they choose, to make a matching contribution to an employee's 401k based on that employee's student loan payments.
Wait, even if the employee isn't putting any of their own cash into the 401k right now?
Exactly. So if you're making qualified student loan payments, your employer can still give you that valuable match in your retirement account. It helps young people avoid that lost decade of saving while they're digging out from under educational debt. It bridges today's financial burden with tomorrow's retirement need.
Okay, those are some positive modernizations, auto-enrollment, student loan matching. But the system still has this fundamental flaw we touched on earlier, tied to the tax breaks. It worsens inequality. You said the government incentives mostly benefit the rich?
Yes, this is probably the system's biggest structural critique. When you look at who gets the benefit of those massive federal tax deductions and deferrals from 401ks, the numbers are pretty stark. Roughly 60% of those tax benefits flow directly to the top 10% of income earners.
60% to the top 10%. That feels unbalanced. How does that work mechanically? Why do high earners benefit so much more?
It's just a function of how progressive tax brackets work. Someone in a high tax bracket, say 35%, gets a much bigger dollar saving from a pre-tax contribution than someone in a 15% bracket.
Right. The deduction is worth more the higher your tax rate.
Exactly. Plus, higher earners are more likely to be able to contribute the maximum allowed each year, further maximizing their tax benefit. So the government subsidy, the tax break, ends up being significantly larger, disproportionately favoring the wealthy.
Okay, so taking all this in the immense scale, the power of auto-enrollment, the student loan innovation, but also the fee drag and this baked-in inequality, what are the key takeaways for Korea? Korea is facing its own urgent retirement challenge.
Right. Korea has incredibly rapid aging, maybe even faster than the U.S. experienced, and a lot of household wealth is tied up in real estate, not in financial assets ready for retirement income. Plus, Korea is right in the middle of that same shift from DB to DC plans, that money move phase.
But there's a crucial difference in how the money is invested, isn't there? U.S. 401ks are heavily into stocks, mutual funds, growth assets. Korean plans, not so much.
That's the critical distinction right now. Korean retirement plans, both DC and the IRPs, individual retirement pensions, are still overwhelmingly dominated by very low-yield, principal-guaranteed products.
Yeah, like bank deposits or guaranteed insurance contracts. Safe, but low return.
Extremely low return, often barely keeping pace with inflation, if that. This cultural preference for safety at all costs, while understandable, severely undermines the system's ability to generate the real long-term growth needed for adequate retirement income.
So, based on the U.S. experience, what are the absolute must-do policy lessons for Seoul?
I think there are three clear non-negotiable actions. First,
Yeah.
mandatory auto-enrollment, just like the U.S. is implementing.
Make it the default.
Absolutely. Aggressively adopt U.S.-style automatic enrollment for DC and IRP plans to maximize participation right away. Overcome that inertia.
Second.
Focus the default option squarely on growth. Korea introduced a default option system, which is good, but it needs to be much more aggressively oriented towards growth-focused, risk-appropriate products like target date funds, TDFs.
So, the default shouldn't be those principal guaranteed products anymore.
Ideally, no. The default needs to reflect a long-term growth strategy suitable for retirement saving, shifting away from the over-reliance on instruments that can't realistically build sufficient wealth over decades.
Okay. And the third lesson, learning from the U.S. fee problem.
Fee transparency and competition. Strict regulatory focus is needed. Ensure clear disclosure of all fees and foster genuine competition among pension providers to drive those costs down. Avoid letting that hidden drag of high fees erode savers' assets like it has for some in the U.S.
Maximize participation, ensure rational growth-oriented allocation, and minimize costs. Sounds like a plan.
That's the core of it, yes.
So, summing up, the 401k, an accidental giant. It transformed U.S. retirement and markets, created trillions in capital, but struggles with fairness and efficiency regarding fees. And we've pulled out some pretty clear, actionable lessons for Korea's own urgent pension reform needs.
It really highlights how even successful systems need constant adjustment and oversight.
Definitely. Now, for our final thought today, something for you, the listener, to chew on. The U.S. is now pushing the 401k envelope even further. They're starting to allow illiquid alternative assets into these plans, things like private equity funds, private real estate, maybe even digital assets.
Yeah, that's a big controversial development.
The idea is to chase higher potential returns and maybe democratize access to investments usually reserved for big institutions. But here's the question for you. Does opening the door to these super complex, often high-fee, low-transparency investments for the average individual saver, does that really democratize access, or does it just democratize risk? Is it a necessary evolution for growth or a dangerous step for people who aren't sophisticated financial analysts?
A really critical question as the lines blur between institutional and individual investing.
Something to mull over. What do you think? Let us know. Thank you for joining us for this deep dive on Story Radio Station. Please remember to like, subscribe, and hit those notifications.
Thanks, everyone. We'll connect again soon on the next topic.